In this video, traders, we're going to look at rules for trading the pullback trade. Stay tuned. Hey guys, well, welcome to you. Thank you for joining me. All right, so pullback is really defined as we've had a good move to the upside. The market then retraces and we're looking for a further continuation. So the thesis is that there's some kind of supply-demand imbalance, some kind of momentum moving in one direction. There's a little bit of a pause and then it's going to continue onward and upwards in the case of an uptrend, or in the downtrend, just flipping on its head. So it's a solid strategy. It works very, very well. There's some ways that we grade the trade, some specific entries and exits for that. But in this video, what I want to do is have some broad ideas to try to stop getting into trouble, because very often, pullback trade is a great trade. Under the right conditions, it's a superb trade. It's very easy, it's very simple, it makes a lot of sense logically. It's just a good, solid foundation trade to have. But so many times we make a mess of it. We do it, we take the trade, and really we shouldn't have. So I've got some rules and ideas, guys, as to when we should take it and when we should avoid it. Now, these aren't kind of definitive, and there's always, you can adapt and adjust, there's always exceptions, but it's a good starting point. So what we want to look for is, if we've got to drive in one direction, we have a pullback. Imagine these are identical. Yes, they're not quite, I know, but excuse my drawing and assume they are. We have a drive up and then we're looking for this. And this is what we're looking for. And ultimately we're buying on this pullback. And like I say, I'm not going into full details about kind of how we're going to execute in a fine granular detail to pull the trigger, but whether we're going to take the trade or not. Now, if you look at a scenario where, let's say, for example, we had, let's just scrub this off for a second, and let's assume now that actually what we had was an open down here and a drive up to here. Or if we're looking at a currency pair, we could say that that was, let's say, a really key resistance level from 2 weeks ago. And we have a push up, and now we start to pull back here. Now, look at that compared to, say, let's imagine this, let's just call this level X, right? Now imagine that level X on this chart was up here, okay? So we've got exactly the same pattern, but we've now got some external influence, i.e. an overhang in this case of resistance, whether that's a gap fill, whether that's a key level or whatever, it doesn't matter. The point is there's some resistance there. And in this case, in this example A, we've got the resistance right on the high, if you like, of that drive. And then on chart B, the resistance is actually even higher. So look at the difference in scenario. The scenario here is that might well stop. Yes, it could break through, and of course that's always going to be the case in some circumstances, but ultimately if it stopped at that resistance, which is the better trade to take? Well, obviously it's going to be B. If you're going to be buying a pullback, you want to ensure that there isn't really anything stopping it. Now, it's never going to be a perfect world. There's always going to be maybe some minor resistance unless you're at fresh highs or something. There's going to be some reason why it might not go there. But you can see the distinct difference, guys, between this and this. There is some brick wall here that needs to be broken for this to actually continue and push on as you want it to. In this situation, that brick wall isn't until further up. Obviously we're doing a hypothetical example here, but we see this all the time day to day. So one of the key rules is just to make sure you don't have a massive overhang or anything that's really restricting the movement between you and fresh highs. Because ultimately the point of buying the pullback is you're expecting a continuation of the trend, right? That's the whole thesis behind it. So if you're buying it here for whatever kind of trigger you're using to get into the trade, if it starts to push up, then there's a good chance that it might just double top. There's a good chance here it might just fade away. There's a good chance it might just stall there. There's a good chance it might fake out and come back in again. And yes, of course, that can still happen here, but you're adding more weight to that fact by having that big resistance level there. So many times, we look at this and we think, oh, it's a great trade, I'm going to buy a pullback, but we ultimately forget that, hey, the pullback, yes, is a good trade, but ultimately there's still potentially other things that are damaging to this. So golden rule number one is that we make sure we don't have any specific kind of overhang, resistance, any key level, any external pressure that might stop this thing from going. Now, of course, you can be flexible with this. If you see things you really, really like, if you see maybe, a catalyst, something going on, then you might ignore that. But under general circumstances, you want to see a nice clean run for it. You don't want to see debris on the road or any obstacles. If you think of a 100-meter race, do you want to see a 100-meter race with no hurdles or a 100-meter race that's flat? Now, obviously the hurdles can be got over, but it's going to make things harder for you. Okay, so that's the golden rule. The second rule that we want to do when we're buying the pullback is we want to make sure that the distance that the price has run already isn't all in a stretched environment. So what do I mean by this? So let's say, for example, we are looking at a daily chart, right? We're looking at a daily chart and we're looking that price has run from here to here, and let's say it's moved 800 pips. Okay, it's a weak movement, as in weak time of day, not as in a week as in opposite of strong. It's in a week, it's moved 800 pips, and that is actually quite a reasonable movement. It's not excessive, it's not small. Let's say it's an average movement that we get. Now, it'd be nice if a currency pair was doing that, but let's imagine that it is for now. And we get 800 pips movement, and we're, say, on a Thursday, and it's pulling back. Now, what's the chances of it continuing with that strength when it's already right at the upper limit of what you'd expect the range to be? Now, there are circumstances, of course, where there's external catalysts that can just blow all those range things out the window. But very often we want to be sure that, hey, under normal circumstances, it might have to take a breather for a few days. It might take a breather on that Friday. It might take a breather on Monday, Tuesday, and just sit there and do nothing before it wants to go again, purely because it's done a very, very short period of time. So again, and if we let's just move to an intraday chart as well. If we imagine that the kind of daily range is let's say 200 pips, and it's already moved 180, then maybe we're going to think, now I just want to put a caveat here, guys. If we've got an external catalyst, and that's different, because ranges can be just exploded when we've got some kind of news coming out, something that's really hitting it. But imagine there isn't, then why would you want to take it when you know that that's probably quite stretched already? You're probably going to have to wait for the thing to unwind a bit, to backfill a bit. So going back to that example of how we're trading, let's say day to day for a currency pair, we wouldn't want to take that straight away, because we'd probably want to let it relax, let it kind of do its thing for a couple of days, and then take it, as opposed to perhaps something that was shorter. Let's say the range again was 800 pips, but it's only done 400. Like, well, I've got 400 pips worth of headroom here. I can take it. I can feel comfortable. This is an unusual thing. I'm not expecting some crazy standard deviation move here. It's just a normal move I'm expecting, so I can feel more comfortable pulling the trigger than I would if it's already done most of the range you're expecting. So the second golden rule, guys, is to look at the expectations of the market that you're trading. Look at the normal range of the market that you're trading, and then start to think, well, how far is it in the normal range? Is it really quite stretched already? Am I pushing my luck here taking a pullback, or is it just really getting started? And again, looking at, have I got any overhang? That's the first rule as well. So the second rule, overhang, anything stopping it. Of course, if the other way around, it'd be any support. And the second rule is just look for, accepted ranges, normal market conditions. If it's already done a massive amount and it's already stretched, then, you're asking a lot for it to go more. And I know there are exceptions to the rule when we have catalysts, and of course that changes the whole game completely, because no one cares then. Everyone's positioning based on new data that's repricing that market. If some bullish data's come out, and forget about your levels, forget about your ranges, people just want in or just want out of the market. So it's a different scenario. But under normal conditions, you have to take that into account. So just watch out, guys, because very often we get caught up in chart patterns that look very tasty, they look very good, but then we're not looking at the bigger picture, not stepping back and going, okay, well, yes, that does look nice, but what's the theme of this? Will it still fit in with the broader thesis and the broader structure of the market? So it's worth thinking about. Take care, guys. See you next one. Bye bye.